when we make a budget, household budget, we tend to have the income and then we decide how much we want to spend out of that income. But the government does not make a budget like that. When the government makes a budget, it first decides what it wants to spend and then it goes around searching for income. Now, if you looked at the government numbers, what we find is that systematically the government seems to be spending more than its income, because this picture which shows the fiscal deficit of the government says that there is consistently a deficit or a situation of spending more than earning. So, what is this fiscal deficit and what does this number tell us?
Fiscal deficit is just the amount that the government spends in excess of what it earns. So, when you compare what it spends and what it earns, we find that typically, especially for India, it spends way more than what it earns. What does the government earn? It earns incomes through two sources. First is of course tax, which is tax revenue, and the second is non-tax revenue. But it spends on many items. There are items that we call revenue expenditure. These are expenses that the government has to incur to run it on a daily basis, paying salaries, paying pensions, interest payments on all the loans and borrowings they have taken, defense expenditure, all the daily expenses of the government. And then there are items that we call capital expenditure, which is the money spent on building infrastructure, ports and airports and hospitals and all the other schemes that the government as the runner of the country has to manage. Now, the problem with India is that the amount that the government earns through its tax and non-tax sources is never enough to cover its expenses.
So, it is not always a bad thing for a government to have a deficit, isn't it? Because governments are expected to spend, governments are expected to incur those expenses to ensure infrastructure development happens, as well as spend on all these items that you have listed. But the government is expected to have a deficit, isn't it? Because it has the responsibility of spending on those heads where it has to spend, whether it is for infrastructure or for the people. So, if you go back and look at that picture which shows the deficit, now it is traditional to show the deficit as a percentage of the GDP. I mean, as if to say what percentage of the total national income is a deficit. So, if you looked at that picture, what you find is that persistently there is a deficit, yes, which means that the government is spending more than its earning. But what we also see is there are years, for instance, look at the time from 2003 onwards, there is a drop in the fiscal deficit. Now, what would have caused this fact that the deficit came down?
Actually, between 2003 and 2008, we had a sort of golden period of fiscal discipline. India undertook to control its fiscal deficit, and we were helped by the fact that the economy was growing very well. So, tax revenues were zooming. With good tax revenues and good economic growth, they were able to earn enough income to cover a lot of their expenditures. We must also remember those were the years in which a lot of foreign investment came in and which took a lot of load off the government's investment responsibility. So, in that 5-year period between 2003 and 2008, fiscal deficit came down. It also helped that the government was mandated by law by an act called the Fiscal Responsibility and Budget Management Act to control its fiscal deficit and bring it down to more manageable levels.
So, after a good period when deficits actually came down from a better income as well as primarily from a better income, it looks like. So, we find in the picture that after 2008, after the global financial crisis, the numbers have just gone right back, and in fact, they have gone up much higher than what was seen later. What went wrong in 2008-9 that the whole situation seems to have got reversed?
Well, starting 2008, both sides of the equation collapsed. Incomes fell and expenses rose. The first 2 years, expenses rose out of the government's own choice. Given the crisis and the magnitude of the crisis, they felt obliged to give a giant fiscal stimulus to keep the economy going. And that immediately pushed up the fiscal deficit from around 3% to over 6%. We had a small break in 2010-11 when they had some telecom auctions which brought the deficit down, and then back again. As the economy continued to slow, income tax collections and corporate tax collections fell and government revenues fell. But expenses did not fall. There were a lot of welfare schemes, socially popular schemes. There were some populist measures which also added to the government's expenditure. And of course, India has always had a problem with subsidies, oil subsidies in particular. When oil prices go up, as they did in 2011 and 12, our subsidies start bloating. With oil subsidies and fertilizer subsidies and a lot of other expenses which could not be curtailed, we were stuck with 5% plus fiscal deficit levels.
This looks like a chronic problem in a certain sense, because there seems to be an unwillingness or an inability to control expenses, while on the other hand income seem to be so cyclical and so related to what happens with GDP. Maybe it would be a good idea to go back and see what these expenses are like, when we talk of the composition of the expense, or where is it that the government is spending money, or maybe we should talk about the quality of this deficit itself. So, what we see here is that during a good period of economic growth, where income comes in and supports the expenses, bringing the deficit down, but we do have a tendency to spend more and for expenses to come back and become large, creating fiscal imbalance, as it were. And also, rating agencies which look at India have always repeatedly expressed this concern that you must have a balance between your income and expenses, and you must not have a persistently high deficit. If we go back and look at perhaps another picture which tells us why is it that the deficit happens, or what has been the quality of our incomes and expenses. This is the picture which I am looking at, and where it is very clear that it is our main source of income is the revenue or the tax, right, and the revenue receipt or the tax income is the main source of income, and the revenue expenditure, that is expense which is incurred for day to day running of the government, which is where which is what is the overshooting element. So, the capital expenditure is not there at all. So, it looks like the deficit, the quality of the deficit is bad, is not it? That we are not spending any money on capital expenditure. So, we are running a deficit, but this deficit is going away to make payments on the revenue side. So, if you looked at this picture which tells us about the components of fiscal deficit, what does it say about the quality of the deficit itself?
Important thing to remember is that the number of the fiscal deficit is not as important as what is causing the fiscal deficit. So, we say the quality is critical. Now, typically a developing country like India would have a high fiscal deficit, as you pointed out earlier. A number like 4 or 5% would not be considered so high, provided the amount that was borrowed to fund the fiscal deficit was going into productive investment. Now, here we have a situation where it is the revenue expenditure, the day to day running expenses, which are causing the fiscal deficit. The difference between revenue receipts and revenue expenditure is called the revenue deficit. And in India, chronically, revenue deficit forms 80 to 90% of fiscal deficit. That is where our problem lies, in not being able to control revenue expenditure or not being able to increase the revenue receipts like our tax receipts. A basic prudent rule of fiscal management is that revenue receipts should fund revenue expenditure, and the leftover bit, capital expenditure, should be funded through other means. Of course, we have seen that is not happening. Our revenue deficit is ballooning and capital expenditure has shrunk. So, now the question is, how is this ballooning revenue deficit being funded? Where is the money coming from?
So, when the government is faced with a revenue deficit and has to find money for it because the tax revenues are not adequate to even cover the revenue expenditure, there are choices. Earlier governments used to print notes. Governments like Zimbabwe continue to do it, and that is very inflationary because you are just putting money into the system. Now, governments have another choice. They can issue bonds or they can borrow from the market. That is the most common way in which most governments bridge their deficits. Indian government also borrows from the market. The US government, for example, has a large deficit too, but they borrow internationally as well. But the Indian government issues bonds. These are your government securities which are issued to fund this deficit. We also call this as market borrowings. Now, a higher deficit would mean that the amount of borrowing is higher. Now, look at the peculiar problem this creates. On the one hand, you have GDP coming down and tax revenues going down because of that, and the government in dire need of additional revenues, which will come with a policy that encourages growth, which should be a lower interest rate regime. So, the central bank would have to follow a monetary policy which keeps interest rates low, such that growth is brought back, which is a problem we have post 2010-11 in the Indian markets. On the other hand, you have the government spending recklessly, so to say, and increasing the deficit and coming into the market with a higher amount of market borrowing. This amount, which used to be about 1.5 lakh crores a few years ago, is now ballooned to 3.5, 4.5 to about 5 lakh crores of borrowing. Now, this means that in the marketplace, you have the RBI wanting to reduce the rates to encourage growth, and on the other hand, you have the government coming in and borrowing because it has to meet the fiscal deficit. Now, interest rates obviously cannot respond to the requirement for it to be down to encourage growth, but instead will continue to remain high because there is supply. There is a supply of bonds coming from the government, or there is a desperate borrower at the door where the market is unwilling to bring the interest rates down. So, for someone who is in the bond market, it becomes a problem, because on the one hand you want to expect rates to come down to encourage growth, and on the other hand you find persistent auctions from the government, because the government is borrowing in the market, which puts these rates up. So, you find that the interest rates get pushed higher because there is a higher amount of market borrowing by the government. Now, RBI therefore is then placed in an unenviable position. On the one hand, reduce interest rates to encourage growth, on the other hand, as the issue manager of the government, try and get a lower rate for the borrowing. So, fiscal deficit actually means that government crowds out other borrowers, dominates the market with its borrowings, and prevents rates from falling. So, is there a way out of this situation?
Well, economists say it does not have to be crowding out. There is a phenomenon called crowding in which if a government manages its fiscal deficit smartly, its borrowings can actually encourage more private participation. Now, that works through enabling government policies. If the government does not have enough money to fund its capital expenses, it can encourage the flow of foreign capital, or it can have policies that encourage the private sector to participate in infrastructure building, things that bring down its expenses and help it to have a lower fiscal deficit. Now, this process will allow the private sector to borrow more from the market and spend, and sort of take up the spending that the government would otherwise have to incur. So, we need to replace crowding out with crowding in. If you have capital coming from non-government players, whether overseas or domestic private participants, that takes care of our capital expenditure, which in turn will give a boost to economic growth, which means that our revenues, tax revenues specifically, will go up, and that will feed back to reduce the fiscal deficit. So, this whole problem of fiscal deficit being cyclical and linked to GDP cycles will come down. So, one possible solution to our chronic fiscal deficit problem is to allow a free flow of capital that helps us move out of this low GDP trap and helps us solve our fiscal deficit problem.
That would be a good thing to have.